Okay, let's go ahead and go on to year 2 of our 2-year translation example with a differential. So here's the information for year 2, and the first thing we need to do is, as always, convert from euros to dollars. Now, 2 of these things are not going to be converted. First, the retained earnings, we're going to carry that forward from the previous year. Now, looking at last year's consolidation worksheet in dollars, the beginning retained earnings in dollars for Little was $1,100. We added their dollar income of $1,298. We subtract their dollar dividends of $115 to get their ending dollar retained earnings of $22.83. So that's the value for retained earnings for year 2. Additionally, last year we had a $217 translation gain in order to make Little's dollar-denominated trial balance. That carries through as end of year 1, beginning of year 2, accumulated other comprehensive income. Again, we look at the worksheet and we see in the owner's equity section, Little has accumulated other comprehensive income of $217. So that's where we start out in year 2. Again, the convention is going to be that AOCI is an equity account. If this number is positive, that's a credit. If it was negative, it would be a debit. Okay, so let's go ahead and convert the rest of these. And again, for translations, it's fairly straightforward. For our assets and liabilities, we're going to use the end-of-year exchange rate. For our paid-in capital, we're going to use the exchange rate from the date of acquisition, January 1st, 2020. That was $1.10. Retained earnings, again, we no longer have a single exchange rate that translates that. We carry forward the dollar amount. Revenues, we have the average rate of $1.25. And dividends, the dividend date rate of $1.20. So converting these things to dollars, we've got the following. Okay, and again, this trial balance isn't going to balance except by rather bizarre coincidence. So we have to find out what sort of debit or credit do we need to make this thing balance. So our total debits, we've got assets, expenses, dividends. Total credits, we've got liabilities, common stock, retained earnings, revenues, and AOCI. So to make this thing balance, again, debits of $17,009, credits of $17,425. So to make this thing balance, we're going to need a credit of $497.50. Okay. And again, that's a credit, so I'm going to treat that as a positive number. Let's go ahead and do the same thing we did previously with our elimination entries. S, as always, we eliminate the beginning of year owner's equity accounts. Carry forward the differential asset. Let me scooch these over so they're not right up against there. And also, Little now has in their dollar-denominated trial balance, they've got some accumulated other comprehensive income. And again, that AOCI is a debit balance, so to eliminate it, we're going to need to credit it. So again, we debit beginning of year common stock, and I could do either, let's go ahead and, yeah, let's do it from here. Beginning of year common stock, beginning of year retained earnings, beginning of year AOCI, and the remaining asset. Again, think of how things carry forward. We could do this one of two ways. We could say, look, at this point, we started out with a $1,000 differential. At the end of last year, there was 800 euros remaining, valued at $1.20, and so we're carrying forward $960. If you prefer, we can look at last year's elimination entries and say, okay, last year, we debited the asset for $1,100, we credited the asset for $236, then we debited it for $96, all of that netting out to $960. We're carrying forward $960. This total, whatever this is going to be split 80-20 between the investment in Little and the non-controlling interest. So the parent is going to get 80% of that plus that plus that plus that. And the non-controlling interest is going to get 20% of that. Okay, A for amortization. Again, we measure, let me move these over. We measure the amortization in euros. The amortization was 200 euros per year, but when we convert it to dollars, we're going to use the average exchange rate. And in year 2, that average exchange rate is $1.25. And again, now we might as well go ahead and do the translation gain or loss related to the differential. And again, we can do this, we can approach this from a couple of angles. First, looking at our entries, we added 960 to the asset in the S entry. In the A for amortization entry, we took away 250. And so the balance is 710. Balance. The desired balance, or the correct balance, again, we measure the differential in euros. We now have at the end of the year, we've got 600 euros of that differential left. Right, again, we started with 1,000. We amortized 200 last year. We amortized 200 this year, so there's 600 euros left. And the end of year value should be reported at the end of year exchange rate of $1.35. So basically, according to our S&A entries, we've got a balance of 710 in that differential asset. We want a balance of 810, so we need to go ahead and add $100 to get that up to its desired correct level. So again, we're going to go ahead and add $100 to the asset and have a $100 translation gain. Okay, I for investment income. Let's go ahead and, before moving any further, let's go ahead and populate Little's column here so we can pull information right off here. Again, just a matter of copying from the dollar column here to the dollar column here. So assets, that, liabilities, that, common stock, that, beginning retained earnings, that, revenues, that, expenses, that, dividends, that, AOCI, that, OCI, that. Okay. Income. Little had reported earnings of $875 in dollars. Again, whether you want to put it formally in the income statement or whether you just want to subtract revenues minus expenses. No matter how you cut it, they've got $875 of income. Big, owning 80% of Little, is going to get 80% of Little's adjusted earnings. And again, this is exactly like we've done forever in terms of measuring the investment income as a function of the adjusted / realized earnings. We start with the reported earnings of $875 and subtract out that $250 amortization adjustment. And again, very, very conveniently, that investment income we just calculated there is the same number that's in the trial balance as investment income. We also have to eliminate Big's other comprehensive income from the translation gain. And let's go ahead and do this exactly as we did last time. Total OCI. We have the trial balance OCI, which was $497.5. We have the differential OCI, which was 100, for a total of $597.5. 80% of that, the parent's share, is going to be $478. Again, very conveniently, that's the number up here as OCI for the parent. The non-controlling shareholders portion is going to be 119.50. In any event, we're going to go ahead and eliminate the OCI translation gain and the investment a little for the parent's share of that. We do the dividends in the usual fashion, and quite honestly, I'm just going to go ahead and copy the account titles. Total dividends declared in dollars was 180. The parent gets 80% of that. The non-controlling interests gets 20% of that. And then lastly, we have the income to the non-controlling interest. And again, I'm just going to go ahead and copy the account titles. The non-controlling shareholders are going to get their share, 20%, of the adjusted earnings. And again, as always, we start with reported earnings of 875, plus or minus the adjustments due to the amortization. We took another expense of 250. So there's the income to the non-controlling interest. The OCI to the non-controlling interest, again, I already did that calculation over here in this area, 119.50. Okay, so we've done our elimination entries. Now it's a matter of posting, again, debits to the debit column, credits to the credit column. So debits to common stock, beginning retained earnings, AOCI, and assets. Again, you need to be careful about the distinction between OCI and AOCI, obviously. This AOCI is the equity account, again, analogous to retained earnings. We credit the investment in little, and we credit the non-controlling interest. We debit the expense, credit the asset. We debit the asset, credit the OCI translation gain. We debit the investment income. We credit the investment in little. We debit the OCI translation gain. We credit the investment in little. We debit the investment in little. We debit the non-controlling interest. We credit dividends declared. We debit the income to the non-controlling interest. We credit the non-controlling interest. We debit the OCI to the non-controlling interest. And we credit the non-controlling interest. Okay, and again, just to feel a little bit more comfortable, I'm going to sum up my total debits, make sure they equal my total credits, and that's good. Those are equal. That makes me happy. Okay, let's go ahead and work through our worksheet now. And again, this is, there's no, the fact that this was initially in euros is now completely irrelevant. Everything's in dollars. The only thing we've added here is the business of the OCI and the AOCI. And again, please notice that this was the OCI, the translation gain from the translation of the balance of the actual trial balance. This is the additional OCI from the translation of the differential. Okay, so revenues, expenses, investment income, net income, income to the non-controlling interest, income to the controlling interest, 2,500. Take that down to our statement of retained earnings. And let's go through our statement of retained earnings. Our beginning retained earnings, credit plus credit minus debit. Income, whoops, I put that in the wrong place. That goes there. Dividends, debit plus debit minus credit. Ending retained earnings, beginning plus income minus dividends. And that goes down to the balance sheet as ending retained earnings. Let's go ahead and work through our statement of other comprehensive income. Again, these were all credits. These were credits are positive, are gains. So credit plus credit, credit plus credit plus credit minus debit Again, that 597.50, that is the gain from the translation of the trial balance plus the gain from the translation of the differential. We're going to allocate 119.50 of that to the non-controlling shareholders, which means that for the parent, or for the controlling interest, there's 478. We transfer that down to the statement of OCI, and now we do this statement of accumulated other comprehensive income, just like the statement of retained earnings, except we don't have dividends. So again, these are positive or credit balances. So credit plus credit minus debit, ending balance, beginning balance plus that, and that goes down to the balance sheet as ending AOCI. Okay, in the home stretch, assets, debit plus debit plus debit minus credit. Same thing here. Goes to 0, which makes me happy. Credit plus credit minus debit, credit minus debit. And again, just to confirm this balances, debits minus credit minus credit minus credit minus credit minus credit goes to 0, makes me happy. Okay, so there's our second year of the translation with the differential. We would do the same thing next year. Basically, each year, sort of the tricky part of this, if you will, is dealing with this OCI adjustment, the other comprehensive income, the translation gain or loss from the translation of the differential. Basically, and it helps sometimes to make a T account to look at this. Again, use your T account for the differential asset. You're going to have your beginning balance based on the S entry and the beginning exchange rate. You'll have your reduction of that differential asset on the credit side based on the average exchange rate over the course of the year. The desired balance is based on the end of year exchange rate, so you need to sort of force it to that desired end of year balance. Okay, if you have any questions, feel free to email me whenever you like. Okay, thanks.